Hey everybody, this is David Skirika. So I'm gonna have an interesting stock chart of the day. This is gonna be kind of again one of my macro longer term stock charts because I had a very interesting tweet come by my Twitter. We're gonna go look at it right now. This is my Twitter here. It was by Mark Halalisco. I'll probably send this video to Mark as well. So he took over for John Templeton. He's a Bohemian. Uh, so he did this tweet. He's run a hedge fund for years. There's not much with him online, but there's an excellent interview with him in 2011. Maybe I'll do that in my Great Trades series at some point. And it was a reason why he kind of turned bullish on, it was a certain kind of indicator he was using. So that's for another time, though. And of course, 2011, there was a correction in the markets, and buying that correction would have done very well. But it's just interesting the way he viewed it. I think it had to do with free cash flow. But anyhow, we're going to look at this now. So here he talks about 17 trillion of treasury bonds coming due in the next 3 to 6 months. Average interest rate will be well below current rates. Now, I don't know what this average interest rate is. Mark probably no one. It's going to be difficult because that 17 trillion is going to be made up of all kinds of different bonds issued at different times. But I would assume where interest rates have been in the last 10 to 15 years, that most of these bonds are yielding 1 to 2% on average. So roughly 200 to 300 trillion or 200 billion in interest expenditures. And now most bonds are short-term orientated in terms of when they're issued. So now we're talking like that's going to be 5 or 600 trillion or 5 or 600 billion sorry, more. Like we're going to have probably 8 to 900 billion on these current interest rates around 5%, 800 to 900 billion in interest, up probably from 200 to 300. So that boom, right away, that can add 5 or 600 billion to the deficit, which where GDP is right now is about another 2% of GDP just in interest expenditure. So what the problem I see now with the market is, of course, the market's looking quite frothy. We have a lot of similarities to 2000, where the Magnificent Seven are similar to the tech stocks in 99, 2000, et cetera, et cetera. All of these sort of things are going on in the markets, et cetera. So in terms of those similarities and the bubbles and the frothiness. So I thought because of the Federal Reserve cutting rates, we can maybe continue and hold up into the election or into next year. But the problem I see now is this is going to be a huge amount of supply coming onto the market. The Fed is not doing quantitative easing anymore. Actually, they're allowing their balance sheet to shrink in the short term. So this, I think, is going to represent a lot of difficulties for the market now here going forward, because this is a huge amount of supply. And how are you going to absorb the $17 trillion of treasuries coming due? So this is the US dollar debt clock. I've shown this in the past. See, the national debt is 34 trillion. Now, remember, the Fed has monetized, I think, like 6 to 7 trillion of this. So really, the amount of debt held by either foreigners or individuals is more like in the 27, 28 trillion range. And I think they even have that here. Yeah. It's somewhere here where it actually shows that as well. So, but anyhow, you can see the 34 trillion. So 17 trillion represents nearly half of that debt. Now, how much is actually the Fed will roll over into the Fed's balance sheet? I don't know, but we can see that we got 4.4 trillion paid right now in total well, that's in total period. Right now we're about, I think, 600 billion, or no, right about $1 trillion in interest currently. So actually what's interesting is the total interest ever paid in debt is 4.4 trillion. We're paying $1 trillion of that this year. So a quarter of the interest ever paid ever in the US debt is being paid this year. And that's the issue with, I just talked about an extra 5 or 600 billion a year. So that 1 trillion could basically go to 1.4, 1.5 trillion very easily overnight. And the government budget is about 6.6 trillion. So the issue is a 6.6 trillion. If all of a sudden, you get to the point where, I don't know, 2 to 3 trillion of the, budget is in interest expenditures, the government basically can't operate. It's too high of a percentage. You can't have 40%, 30% of your budget going in interest expenditures. And if you go look at what they spend on Social Security and Medicaid and Medicare, you'll see that, you can see, the unfunded liabilities are 26 and 40 trillion, but you're talking basically just over $1 trillion on those as well. So you'll be at 2 trillion, you're going to be spending nearly twice the money on interest than you are on these government programs that we've all come to accept as kind of being the norm. So I've always said that the only way they're going to get out of this in the end is they have to monetize the debt. So what's interesting about inflation, this is the long-term CPI chart over here, and you can see this goes back to the 40s. And what I wanted to show you is inflation goes in waves. So this only goes to the late 40s, but what you could see is if this went even earlier, there was a first inflation wave in the early 40s, actually, and then there was, and then we see the 70s. So the 70s had 3 waves here. The first wave was 6% in like 1970. Then the 74 recession was 12, and then 14% at the high of inflation in 1980. And in the 40s, there was a first wave to about 10, and then you see the second wave to about 10, and then this in the early 50s, there was another wave to about 8 or 9, and then we had this low period of low inflation during the 50s and 60s post-war boom. So inflation usually goes in waves. If you actually went in the 19 teens after the pandemic and after World War I, you would see the same thing. There were 2 or 3 waves of inflation. So I think we have just seen the first wave. And if you go look at the 70s, you can see this move from 6 to like 3. We've come down to about 3% right now. And then this move back down to about 4 or 5 after the 74 spike. So probably we're seeing one of these before the next move. And again, with all this debt hitting the market, and they probably have to monetize it, the setup is there for inflation to reaccelerate in 2025 and 2026. And also, like it's just going to be very difficult because a few weeks ago, and I can always admit when I'm wrong, I can always admit when I have to change my mind, et cetera, et cetera. And I talked about how interest rates look like, this is the 3-month treasury here, look like the Fed is going to cut rates are going to go lower, et cetera. Now, this is the 3-month. This basically just tracks the Fed funds rate. But if we go look at something like, I don't know, the 2-year bond. Yeah, here's the yield right here. 4.17. You can see the 2-year bond is now back up to where it was a few weeks ago. We're still below 5%. But if most government debt is issued in that 1, 2, 3-year range. So if we're going to have trillions and trillions of dollars of the 2-year bond issued, that could really spike the yield back, at least back to these October highs of above 5%. So this is a real caveat right now in the markets. Like this is, I don't want to call it a black swan, but again, and then we go look at longer term interest rates here. We can see, look where the 2-year bond, all these bonds, we're talking about that 17 trillion. And again, with most of the US debt being funded by short-term bonds, we can see if we go back to like 2011, most of this debt was issued. This is 0.25%. This is 0.5%. This is 1%. We can see other than this little window here in 2017 to 2019 and the last 2 years, most of this debt was issued at under 1%, and definitely most of it at under 2%. So now we're going to be issuing at 5-6%. So like I said, like this is going to be a huge factor. So you have the combination of Fed's not buying this debt right now. This huge supply is coming on the market, and it's it's already requesting a much higher yield. So what happens to this huge supply hits the market? The market can't absorb it. The Fed is still concerned with inflation, so they haven't switched to the loosening cycle yet, and they definitely haven't switched to QE. This is the kind of thing that could trigger a big meltdown in the stock market. And if we go look at 1987, one of the things that caused the market to tank way back in 1987 was you see this spike in short-term treasury yields. The treasury yield, which bottomed at 6% at the 2-year in the middle of 1986, spiked to over 9%. So that 50% move or 300 basis point move caused it. And notice right here, there was this last move that coincided essentially with the crash from the summer from just over 7% again to 9%. So half of that move essentially happened in that couple months period. So will we see something like that now? I don't know. I cannot say, but I can say that if we look at what's going on with inflation, et cetera, with the way inflation goes in cycles. This is again the 70s. I want to show you this. Inflation probably going to go higher, maybe caused by monetization of the debt and the supply of debt hitting the market at much higher interest rates. I just think this kind of Goldilocks scenario we've had forever now, where governments think they can keep spending like drunken sailors because interest rates have been low, especially in the last 15 years. This is now all coming to an end. And we have a paradigm shift into kind of, probably not having a lot of fiscal backwind and probably maybe a sovereign debt crisis happening. And I know I've been worried about this for 30 years. When I started in the markets, one of the first books I read was by Harry J. Figge. It was called Bankruptcy 1995. And that book had me worried about debt. And of course, Ross Perot ran, one of his main aspects of his platform was worried about the national debt. Now nobody cares about it. So anyway, I hope you enjoyed this. So a stock chart of the day is basically looking at the amount of treasury debt that has to be rolled over. And like I said, I don't have the exact numbers in front of me, but I think it's like 70% of the US debt is in the short-term treasuries. And again, it's how short-sighted the government was that, again, we go look at the 2-year treasury going back 10 years now, when COVID happened, instead of saying, okay, and I'll show you the 10-year treasury in a second, when you had these ultra low rates at zero, the government just issued, I think it was probably 6, 7 trillion, 8 trillion in debt over this 2-year period in 2020 and 2021. And most of it, again, because it was yielding basically zero. I think this year actually might be negative rates, but I had to look, or whatever, it's 0.1%. It was basically zero. So they just figured, okay, we're borrowing all this money at zero. Of course, the Fed was monetizing a lot of it as well. But again, we look at the 10-year bond, it would have been much smarter. Again, you had this basically in 2020, you had almost a whole year where you could have issued 10-year bonds between 0.5% and 1%. And you had a 2-year period where essentially you could have issued every treasury bond issued from basically early 2020 to late 2021 could have been issued at under 2% and actually under 175. So you could have issued that, and then you wouldn't have to roll those over for 10 years. You could have issued, like trillions and trillions of debt, but the government chose not to do that. And that, by the way, that was both administrations, both treasuries, both Trump and Biden. So I think I'll just leave it on that. And I just think that this huge amount of debt that's going to hit the market now has me much, much more worried this year about something happening negatively this year. I kind of did think the Federal Reserve was going to cut interest rates, et cetera. This is why, again, as much as I hate social media sometimes, this is why Twitter and some of these things can be a good tool, because you can find something like this, a little gem like this. So thanks, Mark. And I hope people enjoyed this video, and everybody take care.